Before we move on to tactical patterns, there's one key element I still want to address, is that all of these shaper patterns should be applied to leaders. So for anyone who has studied growth investing or investing in general, it's often come across the word leaders. But what exactly is a leader? How do you define it? I define it with three key characteristics. One is you have strong relative strength, so the stock is outperforming the market and is really a leader in terms of price gains. You have very strong fundamentals, so the stock is profitable, it's becoming increasingly profitable or showing increasing sales growth. And there's a strong story backing this. I mean, there's a new product, a new service, a new technology, or some kind of industry shift that has launched this stock higher. And lastly, there's liquidity. So even if there's a great story and there's great price action, but it's a $2 stock with 40,000 shares a day traded, that wouldn't be sufficient for large institutions to come and step in and buy for weeks at a time. Institutions are huge. I mean, the Contra Fund by Fidelity is over $130 billion, and that's one fund investing in growth stocks. So if you have a $130 billion fund, you can't really be buying stocks trading 40,000 shares a day and that are worth $2 a share. So you really want those three key criteria: relative strength, strong fundamentals with the story, and adequate liquidity and price. When those three factors come together, you really have the potential to have a leading stock. And that's when these leading stocks form these patterns. That is the amalgamation of all the key parameters required for a monster move higher. Beyond just a simple explanation of what a leader is, what does a leader look like? And all of these stocks, as you see as we go through them, I know we've been focusing on the individual patterns themselves, but these leading stocks have a life cycle. Stan Weinstein in his investment classic goes over the different phases of a stock, and what he spoke about years ago is still true today. So let's take an example. We'll take a look at Netflix. We'll see how it progressed through its bullish accumulation phase, how it topped and how it declined, and how it was a leader along the way. Here we're looking at Netflix. So the key points we want to look at is the red line here, as we've said multiple times, is the 10-week moving average, and the blue line is the 40-week moving average. The key point for the accumulation phase is that price is above its 40-week moving average for the entire move, and the 10-week moving average is above the 40-week moving average for the entire move. As you can see, that was absolutely true for this entire Netflix advance. So what is an accumulation phase? Well, basically you start off with initial basing phase, and once you break out of that first cup with handle, you start a phase where institutions accumulate the stocks for months and months on end. Traditionally, William O'Neill mentions that there's 3 or 4 bases before a stock becomes very obvious to most people and it has to have a greater correction. And if you look at Netflix, you basically had 4 bases before you topped and broke lower. Once the stock has advanced for a long period of time and has had some serious price appreciation, you enter a phase where either you have a climax top where the prices blow off to the upside, which we'll cover later, or some stocks just kind of grind to a halt and start to roll over as more sellers overwhelm buyers. And that's exactly what happened to Netflix here. As you can see here, we had our topping phase. There were multiple sell signals, which we'll come to later. And once we've spent a period of time topping, we finally broke below our 200-day moving average, and we started our distribution phase where funds are trying to get out of the stock because the majority of growth has been priced in. And the reason I want to show Netflix, and what's so key here, is again, as I mentioned earlier, I traded Netflix back in 2010, so it's easy for a lot of people to look back and say, wow, Netflix was a great winner. But everyone forgets that in 2011, as you can see on this chart here, along the way from going from its bottom of 2008 to the heights of where it is today, Netflix had an 80% decline in 21 weeks. So regardless of how great the story is, you have to always be aware that along the way you may get some rather dramatic drops. And in my point of view, an 80% decline is way too much for any investor to sit through. And that's why you need your sell rules. In this case, Netflix was able to turn itself around and become the successful company it is today, but the vast majority of stocks that break down and fall that hard never come back to their former highs. So it's important to be aware of the accumulation phase, and when you see signs of topping, you want to be out of the stock before the distribution phase kicks in. And the reason these stocks fall so much is that for the longest time, people are factoring in more and more growth, and they're paying a higher and higher multiple for the stock. And they're factoring in that a stock will grow by 40, 50, 60%. And when they're factoring that in, they're updating their models, they're looking 5, 10 years down the road. If suddenly they say, well, instead of growing for 50% a year for the next 5 years, we're going to grow at 10%. Well, the valuation they place on that company is going to be significantly lower. That's why for most growth companies, you'll notice that on earnings reports, sometimes they may beat earnings, but lower guidance and the stock crashes. And for those who are new, they'll say, like, well, we don't understand. They had a great quarter. But investors, like as I mentioned before, are always forward looking. They're always looking at what's coming next and how they should value this company going into the future. So this is the life cycle of a stock, and you really want to be active for the accumulation phase of the life cycle of the stock. And when those topping patterns show up and you start to see your sell signals, you really want to take your profits and step aside, because if most stocks that fall 80% never come back, and you don't want to be there for that.